Good morning. Welcome to the January 30th edition of Advisory Live. We're powered by Nasdaq IR Insight, and I'm your host, Will Briganti. And joining me today as my guest is Alana Basova. Alana is a senior analyst at Nasdaq Advisory Services with our Strategic Capital Intelligence team. Alana, thank you so much for being here.
Thanks, Will.
It's great to have you back. So today we're going to talk about a letter that BlackRock CEO Larry Fink issued a few weeks ago, which went out to CEOs of major corporations and outlined certain expectations regarding corporate governance. What prompted this action?
Right, so there has been a huge increase of index money in the marketplace, and that has led to BlackRock now managing $6 trillion, which clearly is a great development for the firm, but also it presents a distinct vulnerability. Because first of all, index funds are primarily tied to pensions, endowments, 401ks. All these investments have unusually long time horizons. We're talking up to 20, 25 years. And also index investors don't have the luxury of discretion. If they, for example, disagree with the long-term growth strategy of a company within their portfolio, they cannot just easily divest as an active manager would. So we have long-term holding periods, inability to divest. Clearly, this can lead to overexposure to underperforming equities within the portfolio over the long run due to a variety of macro and micro factors.
So what are some of the key takeaways if I'm like a corporate audience, if I was either to receive that letter or know that it was sort of targeted toward me, if I'm an investor relations professional or a board member or in the C-suite of that type of company, what should I be thinking about?
Right, so index investors can no longer afford to not be heard. Okay. So this letter basically is BlackRock's way of stating to the investment and corporate community that index investors are no longer going to be passive. It is no longer going to be passive, but it's not going to be an active, investment strategy in a regular, conventional sense. Okay. It will be more focused on ESG, corporate governance primarily, and there will be a set of expectations for the corporates. For example, a board will be expected to be engaged year-round, so once a year proxy vote will no longer be sufficient. Sure, of course. The boards will have to be heard now, and the shareholders will have to be heard, so the boards will be expected to be responsive to the shareholders. Actually, ISG Investment Stewardship Group stated that as one of their principles. And also companies overall will be expected to develop clear strategy for the long term and deliver it to the market. And that strategy will have to take into consideration potential headwinds as well as various legislative reforms, such as the recent tax reform, for example.
Right, of course. Well, Alana, thank you so much for breaking that down for us.
Of course.
When we've had you on in the past, we've discussed a lot about ESG, ISG, so this is certainly not going away. And clearly, Mr. Fink's letter has brought this squarely in focus with not just those here in the U.S., but abroad. So
exactly.
Thank you so much for breaking it down for us. Ladies and gentlemen, this was Alana Basova, a senior analyst at Nasdaq Advisory Services. Alana's part of Nasdaq's Strategic Capital Intelligence team. For more information on those services, be sure to visit our website. That's at business.nasdaq.com, and we'll see you back here for another edition of Advisory Live on Thursday. Thanks for tuning in.